the world of finance, few voices carry as much weight as that of Warren Buffett. The legendary investor, known for his shrewd insights and long-term perspective, has recently sounded a warning about the banking industry. Buffett's remarks have sparked speculation and concern among investors, prompting many to reevaluate their positions in banking stocks and reassess the sector's outlook. In this video, we'll explore Buffett's perspective on the banking industry, analyze the factors contributing to the perceived storm brewing, and consider the implications for investors and the broader economy. Buffett's warning: a storm is brewing. At the 2023 Berkshire Hathaway annual meeting, Warren Buffett delivered a sobering message about the banking industry. In response to a question about Berkshire's significant investments in banking stocks, Buffett acknowledged the challenges facing the sector and suggested that a storm is brewing for banks. While Buffett stopped short of providing specific details or predictions, his remarks sent ripples through the financial community, prompting speculation about the potential risks facing banks and their investors. In recent times, the global banking sector has faced unprecedented challenges, leading to widespread concerns about the stability of the financial system. With a perfect storm brewing on multiple fronts, the industry is navigating through turbulent waters, and investors and economists alike are bracing themselves for potential fallout. One of the most significant catalysts of this banking storm is the mounting pile of non-performing loans, exacerbated by the economic downturn triggered by the COVID-19 pandemic. The pandemic-induced economic recession has taken a toll on businesses and consumers worldwide, leading to widespread job losses, business closures, and financial distress. As a result, many borrowers have struggled to meet their debt obligations, resulting in a surge in non-performing loans for banks. With a significant portion of their loan portfolios at risk of default, banks are facing increased pressure on their balance sheets, profitability, and capital adequacy. Furthermore, the prolonged low interest rate environment has added to banks' woes, squeezing their net interest margins and reducing their profitability. Central banks worldwide have slashed interest rates to historic lows in an effort to stimulate economic activity and support financial markets during the pandemic. While these measures have provided temporary relief, they have also eroded banks' income from lending, making it harder for them to generate returns on their assets. Factors contributing to the storm. Several factors contribute to the concerns surrounding the banking industry, many of which have been exacerbated by recent economic and market developments. One key issue is the low interest rate environment, which has compressed banks' net interest margins and reduced their profitability. With central banks keeping interest rates near historic lows in response to economic challenges, banks face pressure to find alternative sources of revenue to offset declining interest income. Buffett has long been wary of the banking industry's susceptibility to systemic risks and has highlighted the importance of prudence and caution in managing financial institutions. He has warned against excessive leverage, complex financial products, and lax risk management practices that can amplify vulnerabilities and exacerbate the impact of a banking crisis. One of Buffett's key concerns is the buildup of non-performing loans in the banking sector, particularly in times of economic uncertainty. He has emphasized the importance of maintaining high credit quality and adequate reserves to withstand potential losses from loan defaults. Buffett recognizes that a surge in non-performing loans can erode banks' profitability, impair their capital adequacy, and undermine investor confidence in the financial system. Additionally, technological disruption is reshaping the banking landscape, with fintech companies and digital platforms challenging traditional banks' dominance. As consumers increasingly embrace online and mobile banking services, traditional banks must adapt to remain competitive or risk losing market share to more agile and innovative competitors. Another concern is the potential for rising loan defaults and credit losses as economic conditions evolve. While banks have benefited from government stimulus measures and loan forbearance programs during the pandemic, these temporary measures may mask underlying weaknesses in borrowers' financial health. As support measures phase out and economic uncertainty persists, banks could face a wave of loan defaults, putting pressure on their balance sheets and profitability. Regulatory and compliance challenges also loom large for banks, particularly as governments and regulatory authorities enact stricter rules and oversight in response to past financial crises. Compliance costs continue to rise, placing a burden on banks' operating expenses and constraining their ability to invest in growth initiatives. Other factors contributing to the banking storm. Mounting non-performing loans. One of the primary drivers of the banking storm is the surge in non-performing loans (NPLs) across the banking sector. The economic fallout from the COVID-19 pandemic has left millions of businesses and individuals struggling to meet their debt obligations, leading to a sharp increase in loan defaults and delinquencies. As a result, banks are grappling with a growing pile of bad loans, which threatens to erode their profitability and strain their capital reserves. Economic uncertainty. The lingering effects of the pandemic, coupled with ongoing geopolitical tensions and trade disputes, have created a climate of economic uncertainty. Businesses are facing challenges such as supply chain disruptions, labor shortages, and fluctuating demand, making it difficult to plan and invest for the future. This uncertainty has ripple effects throughout the economy, affecting consumer confidence, investor sentiment, and overall economic activity. Low interest rates. The prolonged low interest rate environment has added to banks' woes, squeezing their net interest margins and reducing their profitability. Central banks, including the Federal Reserve, have kept interest rates near historic lows in an effort to stimulate economic growth and support financial markets. While low interest rates can stimulate borrowing and spending, they also compress banks' profit margins and hinder their ability to generate returns on their assets. Regulatory and compliance challenges. Banks are facing increasing regulatory scrutiny and compliance requirements, which add to their operating costs and administrative burdens. In the aftermath of the 2008 financial crisis, regulators have implemented stricter rules and oversight measures to strengthen the resilience of the banking sector. While these regulations are intended to enhance financial stability and consumer protection, they also pose challenges for banks in terms of compliance costs and operational complexity. Technological disruption. The rise of fintech companies and digital platforms is reshaping the banking landscape, challenging traditional banks' dominance and forcing them to adapt to a rapidly evolving market environment. Consumers are increasingly turning to online and mobile banking services, bypassing traditional brick-and-mortar branches in favor of convenience and accessibility. As a result, banks are under pressure to innovate and modernize their operations to remain competitive in the digital age. Asset quality concerns. In addition to non-performing loans, banks are facing concerns about the overall quality of their assets. The prolonged economic downturn has raised questions about the valuation of certain assets, including commercial real estate, corporate debt, and mortgage-backed securities. If these assets experience significant declines in value, banks could be forced to write down their holdings, further impairing their financial health. Implications for investors and the economy. Buffett's warning about the banking industry carries significant implications for investors and the broader economy. For investors holding banking stocks in their portfolios, Buffett's remarks may serve as a wake-up call to reassess their exposure to the sector and consider potential downside risks. While banking stocks have historically been viewed as stable, dividend-paying investments, the current environment presents unique challenges that could impact their long-term performance. Moreover, Buffett's comments reflect broader concerns about the health of the economy and the financial system. A banking industry facing headwinds could hinder economic growth and recovery efforts, as banks play a crucial role in providing credit and financing to businesses and consumers. A downturn in the banking sector could ripple through the broader economy, affecting employment, consumer spending, and investor confidence. Navigating the storm. In light of Buffett's warning, investors may be wondering how to navigate the storm brewing in the banking industry. While there are no easy answers, there are steps investors can take to mitigate risks and position themselves for success. First and foremost, diversification remains a cornerstone of sound investment strategy. By spreading their investments across different sectors and asset classes, investors can reduce their exposure to any single industry or company's specific risks, including those facing the banking sector. Additionally, investors should conduct thorough due diligence before investing in banking stocks or any other sector. This includes analyzing banks' financial health, assessing their exposure to risk factors such as loan quality and interest rate sensitivity, and evaluating management strategy and execution capabilities. In light of these concerns, Buffett has advised investors to approach the banking sector with caution and diligence, recognizing the potential risks and vulnerabilities that exist within the industry. He emphasizes the importance of conducting thorough due diligence before investing in banking stocks, analyzing banks' financial health, asset quality, and risk management practices to assess their resilience to potential shocks. Despite his cautious stance on the banking sector, Buffett acknowledges the critical role that banks play in the economy and recognizes their importance in facilitating lending and investment activities that drive economic growth and prosperity. He advocates for prudent regulation and oversight to ensure the stability and integrity of the financial system, calling for transparency, accountability, and responsible governance practices to mitigate the risks of a banking catastrophe. Furthermore, investors should stay informed about economic and market developments that could impact the banking industry. This includes monitoring key indicators such as interest rates, loan delinquencies, and regulatory changes, as well as staying abreast of commentary and insights from industry experts and thought leaders like Warren Buffett. In conclusion, Warren Buffett's warning about a storm brewing in the banking industry underscores the challenges facing banks and their investors in the current environment. While the full extent of the storm remains uncertain, investors should approach the banking sector with caution and diligence, considering potential risks and opportunities as they navigate turbulent waters. By staying informed, diversifying their portfolios, and conducting thorough due diligence, investors can weather the storm and position themselves for long-term success.